Hey, what's up, my friend? So in today's episode, I want to talk about when should you not trade chart patterns. So chart patterns right here refers to things like head and shoulders pattern, the cup and handle, the ascending triangle, descending triangle, pennant symmetrical triangle. You get my point. So when should you not trade chart patterns? So the first thing first is that you shouldn't attempt to trade every single chart patterns out there, because to be honest, some of them, to be honest, I find that they are useless. For example, a chart pattern like the diamond chart pattern, I find it, first and foremost, I don't understand what it means, right? In the context of price action trading. And number two, even if I do know what it means, right, I face difficulty defining my entry point and my stop loss level. So again, right, avoid trading chart patterns that don't make sense to you or are pretty much, meaningless. And I'll talk about this later on and to tell you, which chart patterns you should focus on instead. Number two, don't treat every chart pattern as equal, right? Because they are not. You can have two identical looking chart pattern, but the probability of one working out could be higher than the other. Let me give you an example. Let's say you have a bull flag pattern. It forms right after the price, broke out of, multi-year highs. It just formed a bull flag pattern. And on the pullback, right, the range of the candles is relatively small. And of course, clearly, this market has strong momentum and it's a long-term uptrend. Now, you compare this bull flag pattern with another bull flag pattern, but this time around the market is in a downtrend. Let me ask you, which bull flag pattern has a higher chance of working out? Well, it's a no-brainer, right? The one in an uptrend, the one that broke out to multi-year highs, that bull flag pattern has a much higher probability of continuing to move in its direction. So this is what I mean by, not every chart pattern is equal. You got to look at the context of the market, and we'll talk about that later on as well. And the third thing, right, that you want to avoid, right, is to avoid trading reversal chart patterns that form too quickly. So for example, a reversal chart pattern could be something like the head and shoulders pattern, the inverse head and shoulders pattern. You want to be aware, right, of trading them, right, when the pattern, right, is formed too quickly. So for example, if you take a head and shoulders pattern, right, that took 20 bars to form, compared with another head and shoulders pattern that took, let's say, 100 bars to form, which of these two pattern is more significant? And which of these two pattern, right, is likely to, I would say, lead to a reversal? So in my opinion, right, the one that took longer to form, right, is more significant, because that neckline of the head and shoulders pattern is more significant. More traders will pay attention to that level, and if it breaks, right, it becomes more of a self-fulfilling prophecy where the breakdown, right, is likely to occur. Of course, other context also matters as well, but given all else are equal, I would rather take a reversal chart pattern that took a longer time to form because it's more significant, and the move, right, is likely to be longer as well. Okay, so that's the third thing to bear in mind. When you trade reversal chart patterns, right, be aware of those, right, that form very quickly, like 15 candles, 20 candles, be aware of it. So at this point, right, you might be wondering, okay, Rayner, so I have learned, what not to do when trading chart patterns. So how do I, trade chart patterns, right, correctly? So here are a few tips to share with you. Number one, you want to filter down, right, the chart patterns that you trade. So as mentioned earlier, you don't want to be trading every single chart pattern because a lot of them, right, are pretty much useless or difficult to trade. So focus on those chart patterns, right, with horizontal boundaries. So what I mean by this is that the chart pattern, right, is defined, right, using a horizontal line or area on your chart. This could be something like the ascending triangle pattern, the descending triangle pattern, the head and shoulders pattern with the neckline being, horizontal. These are the type of chart patterns you want to focus on, because these patterns, right, is much easier to time your entry. When the price breaks out of a horizontal area level, it's much easier to define it, because once it breaks out of resistance, it means it has breakout. There's no discretion, there's no subjectivity over here. And also, when you manage your risk, right, your stops, right, can just go below the breakout point. So it's easy to manage your risk. Compared to chart patterns where it involves, let's say, diagonal lines like symmetrical triangle. This one is a bit more tricky because the way you draw those patterns is subjective. And this means that your entry point and your stop loss, right, might be subjective as well, because it really depends on how you draw those chart patterns. So given a choice, I very much prefer to focus on trading chart patterns with horizontal boundaries, and I tend to avoid those with, diagonal lines and stuff like that, because it's much harder to kind of nail down the entry and exits. Okay, so that's the first thing. Second thing, right, if you trade chart patterns, especially trend continuation chart patterns like, the bull flag, or maybe even the ascending triangle chart pattern, let's talk about the bull flag. The bull flag, you want to trade it in the direction of the trend, right? This increases the odds of the trade working out, as I mentioned earlier. So as much as possible, trade chart patterns in the direction of the trend. And it doesn't just have to be trend continuation chart patterns. It can even be reversal chart patterns. If you want to trade, let's say, an inverse head and shoulders pattern that has formed in an uptrend, that's fine as well. right? It's perfectly fine. If you look at or rather, if you read the price action of the market, that's a bullish sign, right? You have a bullish reversal chart pattern in a long-term uptrend. That's a good sign. So as much as possible, trade in the direction of the long-term trend. And number 3, if you want to trade reversal chart patterns, like, let's say head and shoulders pattern, inverse head and shoulders pattern, double top, triple bottom, etc., give those chart patterns time to form. The market doesn't just reverse on a dime. Yes, it does happen from time to time, but more often than not, when the market makes a reversal, it needs time, right, to digest the uptrend or the trending move to go into a consolidation before it breaks down. So when you want to trade reversal chart patterns, my guidelines, to give it at least 80 candles to form, right? So you can see the boundaries on the chart. They are much obvious. So when you want to time your entry, when you want to place a stop loss, right, it's much easier to actually locate it and define it on the chart after the reversal chart patterns has, take time to form. And finally, one last tip I have for you is that if you want to trade reversal chart patterns, you also want to identify what I call a volatility contraction pattern. Right? This is actually a term, right, from Mark Minervini, but the concept is it's basically, right, looking for a decrease in volatility, right, before you trade the breakout. So for example, if you trade, let's say, you want to trade a head and shoulders pattern, right? Market is in an uptrend, it forms a big head and shoulders pattern that took 100 candles to form. So you can imagine the head and shoulders pattern, right, at the right shoulder. Okay, if you sell the breakdown of the neckline, right, the closest stop loss that is going to be is above the right shoulder or above the head. It's going to be pretty wide. So what I want to see instead is a volatility contraction pattern at the right shoulder area. So basically, let's say the right shoulder is this high. I want the volatility contraction pattern to be something nice and tight near the right shoulder. So this way, if I do sell the breakdown of the head and shoulders pattern, my stop loss, right, can just go above the volatility contraction pattern, above the highs of it. So my stop loss is tighter in this sense. So basically, what I'm trying to say that if you want to trade, breakout chart patterns, make sure there's a tight consolidation, right, prior to the breakout. Because if there's a tight consolidation prior to the breakout, you can reference that tight consolidation. For example, if you want to trade the breakout higher, you can reference to the tight consolidation, right, the lows of it to set your stop loss. That's what I'm trying to say. Okay, so let's do a quick recap. Number 1, don't trade every chart pattern out there because some of them are just meaningless and difficult to trade. Number 2, you shouldn't be looking to treat all chart patterns as equal because the context of the market matters as well. And number 3, avoid trading reversal chart patterns, especially the ones that, form too quickly. Okay, so with that said, right, I wish you good luck, good trading. I will talk to you soon.